Kyle, so good to see you. I want to dive into the headlines today, talk about markets and geopolitics with the question, when will stocks recover? Rising tensions in Iran have pushed oil prices higher and created short-term volatility in the markets. Historically, however, geopolitical conflicts tend to have only a temporary impact on stocks. But when we look at that through the eyes of the S&P 500, this is the 1 month performance. We see a lot of red on the board. Why do we tend to see stocks fall first when tensions rise?
Hey, Aaron, good to be with you here. Yeah, this is something that happens in markets, and a big reason is the uncertainty. Markets do not like when there's a lot of uncertainty around a situation and how it's going to impact these companies and their ability to make money. There's a famous quote actually from Benjamin Graham way back in the day, and he has a quote. It's great. In the short term, markets are like voting machines. They're driven by emotions, headlines, and sentiment. And in the long term, they're more like weighing machines where they're going to be driven by earnings, growth, and the fundamentals of these different names. So I like that quote a lot because you can see in the short term it's so emotionally driven by a lot of uncertainty.
Right.
But markets do a good job of balancing things out.
So let's take a closer look at history. I know you love taking a deeper dive here, Kyle. So history shows that the S&P usually recovers quickly from geopolitical events. And as we see here, this shows several events and mostly short, shallow pullbacks. What are we looking at here? Talk me through it.
Yeah, this is a great visual. Along the bottom, you can see the drawdown in the S&P 500 for these different events on this little chart, and then along the top axis, the top axis here, the number of calendar days that it took to recover from that drawdown. So you can see a lot of these events, and they're big ones in history. They were less than 10% in terms of the drawdown that we saw, and they lasted less than 100 days. So quick and fast is what we usually see with these geopolitical events.
Certainly feels more stressful when we are in the moment. It helps to look at that. So for investors who are watching these headlines and rising oil prices, what is the most important perspective to keep in mind before making any portfolio decisions?
Well, the biggest thing is you got to look and see how this impacts your plan, if at all. 2026, I think, probably was a wake-up call to some investors who got pretty complacent through a couple of good years that we've really had. We haven't seen a shock like this really since the Russia-Ukraine war in 2022. This is kind of our first big wake up. So it all goes back to having a plan. If this event has damaged your portfolio to the point where you have to adjust your financial or retirement plan as a result, maybe you weren't invested properly in the first place, and you really need to examine that, and working with a pro can really help.
Right. And that brings us to kind of my next question, Kyle, which is emotional investing, because a lot of people I do think are reacting to these headlines and feeling compelled to make portfolio decisions when maybe they shouldn't be. But explain how emotional investing tends to lead to bad financial decisions.
It definitely can. And what you've got on the screen there is that kind of roller coaster of emotion. And, you can see up at the top, the euphoria. That's usually the point of maximum risk. This is when people, emotionally speaking, are most comfortable making a big bet on the market. And, despondency on the other side of that visual, that's the point where, you have some opportunity, but it usually feels that way. And we want to avoid the emotional investing because it can cloud your judgment. And what it does now, usually the big knee-jerk thing I see from clients or prospects is that they try to say, hey, I'm going to jump out of the market at this point, and then I'm going to try to jump back in at a better point when things get better. But that creates a huge challenge because not only do you have to time your exit perfectly, you have to time your reentry perfectly. You don't want to come out at the bottom and jump back in at the top, which is a very common mistake. So having the right plan, having the right portfolio for your risk tolerance can help remove the pressure, take some pressure off the situation.
Yeah, you want to be making decisions based on data, not on your emotions or, the guarantee or hope that you'll get lucky twice. That's a really good reminder. Right. Kyle, that being said, so if somebody is feeling stressed and recognizing that maybe they didn't have that financial plan or a plan that was in line with their risk tolerance, what's the best way to reach you to get a second opinion and talk this through?
Absolutely. Best way is through the website. That's firstcoastfinancialgroup.com.
Great. Kyle, thanks for your time today. I appreciate it.
Thank you, Aaron.